Good afternoon, friends. In today's class, we will discuss Unit 13 of Financial Management, that is dividend policies. Before discussing this dividend policy, let me first tell you the objectives of our discussion today. First, the objectives are: first, we will discuss various forms of dividend. Next, we will discuss the factors affecting dividend decisions. Next, we will discuss different types of dividend policies. So, our objective is to discuss various forms of this dividends, to identify factors affecting dividend decisions, and to explain different type of dividend policies which are usually followed by companies. Next, we'll discuss the structure of our discussion today. First, I will give the introduction of dividend policy. Then we will discuss different forms of dividend. Then we will discuss factors affecting dividend decisions. Next, we will discuss different types of determinants of dividend policies. Those are external factors and internal factors. Next, we will discuss different dividend policies. There are four types of dividend policy which we will discuss. One is stable rupee dividend, another is incremental dividend policy, another is stable dividend payout ratio, another is residual dividend policy. Then we will summarize our discussion. We will discuss some keywords and some important questions. Friends, a business always earn profit. Once it earn profit, then the next important decision the finance manager has to take, that is how to use this profit. What percentage of profit is to be paid back to the owners as dividend, and what percentage of profit is to be retained and reinvested in the business. That means what percentage of profit is to be paid back to shareholders and what percentage of profit is to be plowed back in business. That means dividend decision is regarding two important ratios. What are the two important ratios? First ratio is that is payout ratio, and second ratio is retention ratio. So dividend decision is the decision regarding paid back and plow back. How many percentage of profit is to be paid back to shareholders and how many percentage of profit is to be plowed back in the business or reinvested in business. Friends, this decision is not so problematic in partnership business or sole tradership business, because in case of sole tradership business, the owner is the manager, he is the decision maker, and in case of partnership business, the partners are the owners as well as the managers and the decision makers. But in case of company form of business, there is a separation of ownership and management. In case of company is owned by shareholders, but the company is managed by BOD or board of directors. There is a separation of ownership and management. The manager or the board of directors decides what percentage of profit is to be paid back to shareholders, and they put their recommendation before the shareholders in the AGM, and in the AGM shareholder approve this. So the decision is taken by board of directors, but the dividend is to be taken by the shareholders. So there is a complexity in case of corporate form of business regarding dividend policy. Similarly, in case of company, there are other stakeholders which are also involved. Their interest is to be taken into consideration at the time of designing dividend. Who are the other parties? The other parties may be employees, the other party may be shareholders, the other party may be debenture holders, they be lending institutions. In case of shareholders, there are also different type of shares, preference share, equity shares, and the shareholders group may be different. There may be high income group shareholders, there may be low income group shareholders. So all these stakeholders interest is to be taken into consideration while designing the dividend policy of a company. So a company must have a long-term stable policy regarding dividend decisions. It must have a long-term policy regarding dividend decision. It must have its dividend policy must be stable one. So this is regarding dividend decisions. Next, we will discuss what are different ways in which dividend can be paid to the shareholders. So that is known as different forms of dividend. What are different forms of dividend? We know that normally the dividends are paid in cash. When I tell the term cash, I means it is paid through check or it is paid through bank transfers, not in hard cash. So mostly dividends are paid in form of check or in form of bank transfers. Clear? So dividends are paid in cash. But what are the other ways in which dividend can be paid? There are certain other ways in which dividend can also be paid. Those ways are stock dividend, those ways are scrip dividend, those ways are debenture dividend, those ways are stock split, those ways are buyback of share. So we will discuss one by one what are the other ways in which dividends can be paid. But most of the companies pay their dividend in form of cash. So cash dividend is the most important form of business. But there are certain other ways in which dividend can be paid. So another popular way of making payment of dividend is stock dividend. So what is stock dividend? Stock dividend simply means issue of bonus shares. What is bonus shares? Bonus shares are those shares for which the shareholder get the shares but does not pay anything. That means those shares are available at free of cost to the existing shareholders. That means how these bonus shares are paid? Bonus shares are paid by capitalizing the reserves. So Companies Act tells that dividends can be paid out of accumulated reserves of the company in way of bonus shares. By capitalizing the reserve, we can issue bonus shares. So bonus shares, if a company decides to pay dividend in form of bonus share, then it can pay dividend in form of bonus share. If it pays dividend in form of bonus share, the cash flow of the business is not affected. So it's a way of making payment of dividend without affecting the cash position of the company. Then how bonus share is issued? Let's take an hypothetical example how bonus share is issued. I have already told bonus share is issued by capitalizing the reserves. Bonus shares are those shares for which shareholders get share but do not pay anything. These are paid in lieu of dividend. Let's take an example. Suppose a company is there, its company's name is, let's take an example, ABC Limited. So this is ABC Limited. Its paid up share capital was 1 crore share of 10 each. So what is the paid up share capital total? 10 crores. Its paid up capital share was 10 crores. Then its reserve and surplus is 10 crores. So what is the total net worth of the company? Total net worth of the company is the share capital plus reserve surplus 20 crores. So am I clear? It has a share capital of 10 crores, reserve and surplus of 10 crores. Now the company decided to issue bonus share. What it will do? It will issue bonus share. Company decided to issue bonus share in the ratio of 1:2. What does it mean? If you have 2 shares, you will get 1 additional bonus share. That means in case of 1 crore shares, 50 lakh additional share will be issued at the rate of 10 per shares. So there will be 50 lakh bonus shares to be issued. If 50 lakhs bonus shares is to be issued, 5 crore, 50 lakh into 10, 5 crore worth of bonus share will be issued. And this 5 crore will be added in the paid up share capital. Its paid up share capital will be 10 crore plus 5 crore, that will be 15 crores. So the paid up share capital will be 10 plus 5 after bonus issue, that is equal to 15 crores, and its reserve surplus will come down by 5. 10 minus 5, that is equal to 5 crores. So this will be post issue balance sheet of ABC Limited. Let's take an example. What will be the post issue balance sheet? Pre issue balance sheet is this pre issue balance sheet, and post bonus issue balance sheet will be like this. Post bonus issue balance sheet. Post bonus issue, it's there will be increase in the paid up share capital and there will be decrease in reserve and surplus. It will be also be 20 crores, but the calculation will be like this. Paid up share capital will be 15 crores and reserve and surplus will be 5 crores. Let's look at this, how the post bonus issue balance sheet looks. Post bonus issue balance sheet, it will be like this. Post bonus issue. Post bonus issue balance sheet of ABC Limited. What will be there? Paid up share capital will be 1.050 crores of 10 each. So it will be 15 crores. And reserve and surplus will be 5 crores. So total will be 20 crores. So this is known as post bonus issue balance sheet of the company. So there is pre-bonus issue and post-bonus issue. So bonus share is a form of making payment of dividend to the shareholders. In this case, instead of making payment of dividend in cash, company capitalizes its reserves and issue additional shares to the existing shareholders in form of bonus shares, for which the shareholders do not have to pay anything. This is known as bonus issue. It's a form of making payment of dividend. Next, we will discuss stock split. What is stock split? Stock split, the term split means dividing. If there is a big thing, we will divide it into small things. That is known as stock split. Suppose a company's share is there, its market value is 2000 per share. So its par value is 10 rupees per share. So a 10 rupees share can be splitted into 2 5 rupees shares, or it can be splitted into 10 1 rupee share. This is known as stock split. So it is a method of increasing the number of shareholders outstanding and thereby proportionately raising the market price per share. And this is known as stock split. There can be a reverse stock split. What is reverse stock split? In case of reverse stock split, 10 1 rupee share will be combined into 1 10 rupee share. Stock split, 1 10 rupee share is divided into 10 1 rupee share. But in case of reverse stock split, 10 1 rupee share will be combined to 1 10 rupee share. This is known as reverse stock split. If a company believes that the stock price is too high and the trading activity of the stock is low, in that case, the company may go for stock split. The company will go for stock split if it believes that the share price is very high in the market. The market price of the share is very high, and what happens? The second thing is the trading activity in that stock is low because the share price is high. Let's take an example. Suppose before stock split, what was the position of a company? This is the company named PQR. PQR. In case of PQR Limited, what happened? Before stock split, what is the position? There was common stock of rupees 2 lakh share with 10 par value. 2 lakh share of 10 par value. The 2 lakh share is splitted into 2:1, 4 lakh share. So the stock is splitted into 4 lakh share. So rupees 10 share is splitted into 2 5 rupees share of 5 each. So it happens to 2 lakh. So in case of stock split, the paid up share capital value remains constant, but there is increase in the number of shares. but there is a decrease in the face value of share. Face value of share decreases, number of share increases. Face value of share decreases, number of share increases. So in case of stock split, the number of share increases, but the face value of share decreases. 2 lakh shares becomes 4 lakh share, rupees 10 per value share become rupees 5 per value share. This is a way of payment of dividend to the shareholders, stock split. Then another way is there, that is stock repurchase or buyback of share. What is buyback of share? The company may buy its own share from the existing shareholders. Generally, which company can do this go for buyback? The companies with extremely good liquid position. Which position is liquid position is extremely good, which have sufficient cash balance in their hand, which are cash rich company. Generally, cash rich company go for stock repurchase or buyback of share. A company can buy back its own stock from the existing shareholders. The buyback can be made in 2 ways. The buyback can be made by a tender offer. What is a tender offer? A flat offer will be given in the open market. The tender offer will be there, or it can be obtained through open market through book building process or to exchange of odd lot shares. So stock repurchase can be done in 2 ways, through a tender offer. Tender offer means company will give an offer to the shareholders. If you want to give your shares back to the company, company is ready to take it at rupees 20. This is a tender offer. Or company can give a open offer in the open market. It will buy the shares, buy back the shares through book building process. In case of book building, the price is decided by the market participants, not by the company. Company gives a range of price, and within this, the shareholders bid and the price is decided. And this is known as book building process. Similarly, the company can give offer to the odd lot shareholders. What is odd lot shareholders? Suppose you have purchased 112 share. So here 12 is odd lot share. So if you want, you can give this 12 share back to the company. That is known as odd lot shareholders. Next, property dividends. What is property dividend? What is property dividend? In case of property dividend, the dividend is paid in form of inventory or securities. If there is a cosmetic manufacturing company and it pay dividend by paying a cosmetic pack to its shareholder, this is known as property dividend. Okay, this type of dividend is not allowed in Indian Companies Act. The company may pay the dividend in form of securities or share of its holding company, of its subsidiary company. Subsidiary company का शेयर दे सकते हैं, इसको बोलते हैं प्रॉपर्टी डिविडेंड. प्रॉपर्टी डिविडेंड इज नॉट अलाउड इन इंडियन कंपनीज एक्ट 2013. नॉट अलाउड. In India, what is allowed? Cash dividend is allowed, stock dividend is allowed, stock split is allowed, buyback of share is allowed. These are the 4 ways in which dividend payments can be made. Other ways of paying dividend is not allowed in Indian Companies Act 2013. Next, property dividend. So in case of property dividend, the dividends are paid in form of inventory or securities of which company? Subsidiary company. This is known as property dividend. Next one is debenture dividend. What is debenture dividend? In this case, instead of paying dividend in cash, the company issued debentures to the shareholders. So if debentures are issued in lieu of dividend, that is known as debentures dividend. The debentures carry interest and debentures are payable after a prescribed period. It is just like creating a long-term debt. So this is not a common practice. In India, also this type of dividend is not allowed. In India, stock dividend and cash dividends are allowed. Next one is scrip dividend. What is scrip dividend? What is scrip dividend? In case of scrip dividends, the dividends are paid in form of promissory notes. That means instead of paying dividend, company give a promissory note to you. That means I will pay the dividend after 5 months, after 8 months. So if the company pay dividend in form of promissory notes or in form of convertible dividend warrants redeemable in few years, that is known as scrip dividends. In Indian Companies Act, scrip dividend is not allowed. But in Foreign Companies Act, the scrip dividends are allowed. Then there is another concept of dividend is liquidating dividend. If a company is to be liquidated in near very soon, the company may pay liquidating dividend. So what is liquidating dividend? In this case, dividends holders, shareholders pay dividend equal to the amount they have already paid to the business. That means if the shareholders are given back their capital which they have originally invested in the business, that is known as liquidating dividend. Liquidating dividend is a sign of shutting down of the business. But liquidating dividend payment is not allowed in Indian Companies Act. So in Indian Companies Act 2013, two type of dividends are allowed. One is stock dividend, another is cash dividend. These are the two major ways in which dividend can be paid, and stock split and buyback of shares is also allowed in Indian Companies Act subject to certain conditions fulfilled by the company which are mentioned in Companies Act 2013. Next, we will discuss different factors affecting dividend decisions. What are the factors which affect dividend decision of a company? So generally, the factors which affect the dividend policy of a company can be classified into two parts. One is ownership related factor or ownership consideration. Another is farm related factors or farm oriented consideration. So while deciding the dividend, two type of consideration, dividend policy, two type of consideration must be taken into account. One is known as ownership consideration, another is known as farm oriented considerations. So what is ownership oriented considerations? These are the factors which must be considered before paying dividends which are related to owners. Owners means shareholders. So the factors which are related to the shareholders of the company which must be taken into consideration before designing the dividend policy of a company are known as ownership consideration. What are the ownership consideration? First one is current income requirement of shareholders. Who are your shareholders? What is their current income requirement? Does they require income regularly? Are they old aged person? Do not have whether they have alternative source of income or dividend is the only source of income of them? We have to analyze. This is current income requirement of shareholders. Second one is alternative use of funds in the hands of shareholders. Alternative use of funds. While taking the dividend, what type of use the shareholder will do with the funds that they receive in form of dividend. Next, tax matters of the shareholders. The person who take dividend are in which tax bracket? High income tax bracket, who are paying the highest slab of income tax 30% in India, or they are in lower bracket. So we have to analyze these ownership related consideration while designing the dividend policy of an organization. Next, we will discuss different farm oriented consideration. What are the farm oriented consideration? Farm related things, farm related matters which affect the dividend policy. First one is contractual and legal restriction. What are the contractual restrictions? What are the legal restrictions imposed on payment of dividend? Next one is liquidity requirement of the company, credit standing of the company. working capital needs of the company, contractual and legal restrictions, liquid credit standing and working capital needs of the company. Next, what is the need of the company or need of funds for immediate or future expansion? Whether the company has some future expansion plans or not. What is the need of funds for the company? Next, we have to analyze availability of external capital. Then we have to analyze the risk of losing control. Whether it's a family-run business, and if you will include new members, your control will be diluted. We have to analyze. Then we have to analyze the related cost of external funds. We have to analyze whether the business cycles, whether there is recession or boom in the economy. And we have to decide the post-dividend policies of stockholders and their relationship. So these are certain farm-oriented consideration of dividend policy. Next, we will discuss different determinants of dividend policy. What are the factors which affect the dividend policy of a farm? Those are known as determinants of dividend policy. The dividend policy determines the distribution. What is dividend policy? It determines the distribution of earning between shareholders. It's the decision regarding payback and plowback. How many percentage of profit is to be paid back and how many percentage of profit is to be plowed back in the business. Paid back to the shareholders, plowed back in the business. That decision is known as dividend policy. While designing the dividend policy, we have to consider different factors. These factors affect the dividend policy of an organism. The factors can be classified into two parts. One is external factors, another is internal factors. So what are the external factors which affect the dividend policy of an organism? What is the external factors? External factors are those factors which are uncontrollable in nature. These cannot be controlled by the decision of the management of the company. These are outside factors. Hence, we have to find out what are the outside factors which decide the dividend policy of an organism. The first outside factor is state of economy. What is the state of economy of the organism, of the country? Whether there is a boom phase or there is prosperity phase or there is a recession phase. If there is a boom phase, the market price of the shares increases. The company needs fund for expansion, diversification. Hence, in this particularly boom phase, company pay less and less dividend and it retain more and more profit. Similarly, at the time of recession, what happens? At the time of recession, the business face problem for contracting sales, mounting inventories, decreasing profit. So if recession persists, company cut down its production. So at that time, what should be the dividend policy? That we have to find out. The next factor which affect the dividend policy is the state of capital market. What is the position of capital market? Whether the capital market is overwhelmingly in favor of equity issue. If most of the equity issue are successful in capital market, the company may adopt a liberal dividend policy. That means if it need funds in future, it can approach the capital market as and when required because the condition is favorable. But if the condition in the capital market is adverse, then in that case, the company has to depend upon internal funds. And in that case, the company should not pay liberal dividends. It pay less and less dividend. So second factor which affect the dividend policy is state of capital market. The next factor which affect the dividend policy is tax policy. Generally, two type of tax rates available on dividends. First, if a person take dividend, so a dividend tax is imposed on it. What is the rate of dividend tax? And if the person does not take dividend, the amount is reinvested in business and the share price increases by way of this. And in future, when the person need funds, it may sell some shares. And if it sells some shares, capital gain tax is attracted. So there are two type of tax: dividend tax and capital gain tax. So we have to analyze whether dividend tax is less or capital gain tax is less. On that basis, we will decide the dividend policy. If dividend tax is less, then we will pay more and more dividend. If capital gain tax is less in comparison to dividend tax, in that case, we will pay less and less tax, less and less dividend. If our shareholders are in a high tax bracket, then dividend will be taxed at a higher rate. If they are in a low tax bracket, dividend will be taxed in a lower rate. So on that basis, we will find out the dividend policy on the basis of taxation. The next point which affect the dividend policy is inflation. What is inflation? Inflation is a factor. Inflation is an economic situation where there is a steady rise in the price of goods and services for a long period of time. So a steady rise of the price of goods and services is known as inflation. During the period of inflation, what happens? If you pay 100 rupees dividend now, when there is 5% inflation, and 100 rupees dividend when there is 15% inflation, in that case, the 100 rupees amount is not same. In order to equate the stable amount of dividend which you paid when 5% inflation was there, when 15% inflation is there, you have to pay more dividend to equalize the dividend in different countries, in different periods. So, at the time of inflation, dividend payout ratio is generally high, or a higher payout ratio is to be made at the time of inflation But if the inflation situation is within control, inflation is within limits, in that case, more and more dividend should not be paid. In that case, a small increment in dividend will be sufficient to maintain stable dividend policy. Next one is requirement of institutional investors. In a company, there are different category of investors. There are retail investors, there are institutional investors. Who are the institutional investors? Institutional investors are financial institutions, banks, insurance companies, mutual fund companies. They are institutional investors. While designing dividend policy, their requirement must be considered. So we have to consider both the requirement of retail investor as well as institutional investors. रिटेल इन्वेस्टर्स का ध्यान रखेंगे, इंस्टीट्यूशनल इन्वेस्टर्स का ध्यान रखेंगे डिविडेंड पॉलिसी को डिजाइन करने के टाइम। नेक्स्ट हम बात करेंगे व्हाट आर द इंटरनल फैक्टर्स अफेक्टिंग डिविडेंड पॉलिसी। कौन कौन सा इंटरनल फैक्टर है जो डिविडेंड पॉलिसी को इंपैक्ट करता है बिजनेस में। Internal factors. What are internal factors? Internal factors are those factors which are within the control of the company. These are within the control of the company. The company can make changes in these internal factors and it can design its dividend policy. What are the internal factors which affect the dividend policy? We'll discuss one by one. Internal factors. The first internal factor is nature of business. What type of business you are doing, that affect the dividend policy. Now please see, if in your business there is a steady demand, then you can follow a liberal dividend policy. But if in your business there is seasonal variation or cyclical variation in demand for the product, then liberal dividend policy cannot be followed. Suppose you are in consumer goods industry where there is uncertainty regarding income, so more dividend cannot be declared. But suppose you are in public utilities business where income is more or less fixed, so you can pay fixed rate of dividend. A healthy company can pay more dividend than a problematic company, a suffering company. If your earnings fluctuate more, you can pay less dividend. Then a company which believes in public gimmick by following a more liberal dividend policy will pay more dividend. So these are some of the factors, internal factors which affect the dividend policy of the organization. Another important factor is composition of shareholders. What type of shareholders are there? If your shareholders belong to low income brackets, retired person, and they want a regular dividend, so you have to pay regular dividend irrespective of the earning. In that case, you have to design a separate dividend policy. But if your shareholders are wealthier persons, then another type of dividend policy will be done. If your company is a closely held company, family run companies, number of shareholders is less, in that case a different type of dividend policy is to be taken. But if your company is a widely held company, like in case of public company, listed public company, where shareholders are many, shareholders are scattered, a separate dividend policy is to be designed. Similarly, the tax burden on business corporation also decides the dividend policy of the organizations. So we have to decide. Next factor which affect the dividend policy is alternative use of funds. What is alternative use of funds? If the shareholders take dividend, what use they will make the funds available in form of dividends? That also decides the dividend policy. Okay, so if more attractive alternatives are available, they demand more and more dividend. But if less attractive alternatives are available, they do not demand dividend, they prefer plowback of profit or reinvest of the profit in the business. So that is one factor. Next, control. We know that if a company has profit and it distributes dividend, what happens? Its internal finance comes down. Internal finance means if it requires funds in future, it does not have sufficient amount of internal finance, sufficient amount of retained earning. So what it has to do in future, when it need money, it has to issue equity shares, further equity shares. If a company issues further equity share, then what happens? Number of existing shareholder will increase in future. Once the number of shareholders increase, there is a dilution in control. There is dilution in control. If there is dilution in control, control will be diluted. Then what will happen? Then the control, of the existing shareholder will lose. If the person believes in empire building, generally they do not want to dilute the control. In that case, those companies generally pay less amount of dividend. And those companies which do not mind of dilution of control, they prefer liberal dividend policy. They tell that more and more dividend should be paid. Then desire for liquid funds. What is the desire of the company? What is the necessity of the company for liquid funds? If a company has more liquid funds, then it will give more amount of dividend. If it has less liquid funds, then it will have lower amount of dividend. The cash credit limit of the company, working capital needs of the company, capital expenditure commitments of the company, repayment of long-term debts of the company also affect the dividend decisions. So these are some of the factors which affect the dividend decisions. Next, we will discuss what are the different types of dividend policies usually followed by business or by companies. Generally, we have discussed dividend policy is a decision regarding plowback and payout. What percentage of profit is to be plowback in business and what percentage of profit is to be payout to its shareholder. This is the dividend decisions. And while deciding these dividend decisions, generally the following aspects are to be considered. First, what are the aspects? What are the things? Generally these aspects must be considered while designing the dividend policy of an organization. First one is dividend policy should be analyzed in terms of its effect on value of the company. Dividend decision should not be treated as a short-term residual decision. Dividend policy should be, as far as possible, communicated clearly to the investors, and there should not be erratic and frequent changes in the dividend decision or dividend policy of the organization. Erratic and frequent changes in dividend should be avoided. So what are the options available before the companies? Generally, three options are available. The company may pay regular dividend. What is regular dividend? Regular dividend means the company will pay same amount of dividend year after another. That is known as a regular dividend. Every year the company will pay some dividend. Then next there is stable dividend. Every year dividend will be paid, but the amount of dividend will be same. Regular dividend means every year dividend will be paid. Stable dividend means regular every year dividend will be paid and the amount of dividend will be same irrespective of the amount of earning. Next one is a fixed payout ratio. That means every year dividend will be paid as a fixed percentage on the earning of the company. So these are the three ways in which three options available for dividend payments. Now we'll discuss some of the important dividend policy decisions. First important dividend policy decision is stable rupee dividend. What is stable rupee dividend policy? Please see what is stable rupee dividend policy. In this case, a fixed amount per share as dividend is paid every year. Every year, a fixed amount of dividend will be paid. The earning will have no influence on dividend. The earning may increase or decrease, but the dividend remains same. Just look at this. These are the earning. First year earning is this, dividend is this. Second year earning is this, dividend is this. Third year earning increases, but dividend amount remains same. Fourth year earning increases, but dividend amount remains same. Fifth year earning comes down, but dividend amount remains same. Sixth year earning increases, but dividend amount remains same. Seventh year earning increases, but dividend amount remains same. Every year, if the dividend amount remains same, the first in this graph you can see this is stable rupee dividend policy. The EPS, earning per share, increases or decreases, but the DPS remain constant. And this is known as stable rupee dividend policy. Here EP, though there is changes in EPS, but there is no change in DPS. EPS means earning per share, DPS means dividend per share. If this happens, this is known as stable rupee dividend policy. There is another variety of stable rupee dividend policy that is known as incremental dividend policy. So stable rupee dividend policy is simple and easy to follow. But if the earnings fluctuate widely, it is difficult to maintain fixed rupee dividend or fixed rate of dividend. So stable dividend is good, stable rupee dividend, if there is low fluctuation in earning. If there will be erratic fluctuation in earning, this method will be difficult to maintain. Another variety of stable rupee dividend is incremental dividend policy. So what is incremental dividend policy? Incremental dividend policy is a dividend policy where dividend has no relation with the earning, but there is a constant increase in the dividend year after year. Now please see, this is known as incremental dividend policy. Here earning may increase or decrease, but the dividend amount increases at a constant rate every year. First year dividend was this, next year dividend increases, next year dividend increases, dividend increases, dividend increases, dividend increases. So dividend increases in a stepwise manner. This is the shape of EPS and this is the shape of DPS. In case of DPS, the dividend increases in stepwise manner, but it does not have any relation with the earnings of the company. This is a variety of stable rupee dividend, that is incremental rupee dividend, and this is applicable for growth companies. Which companies where there is a stable growth in the earning of the company, they may adopt this particular incremental dividend policy concept. Next, another variety of dividend policy is stable dividend payout ratio. What is payout ratio? Payout ratio means percentage of profit that is distributed as dividend. Payout ratio is equal to DPS by EPS, dividend per share by earning per share. If you maintain payout ratio constant, suppose your payout ratio is 40%. If your earning is 4 rupees, you will pay a dividend of 1 rupee 60 paisa. If your earning is 5 rupees, you will pay a dividend of 40%, that is equal to 2 rupees. This is known as your payout ratio year after year remain constant, but the dividend amount changes as earning changes. You can see it in this first case, as earning changes, dividend amount changes. As EPS changes, DPS changes. If in PS increases, DPS increases. If EPS decreases, DPS decreases. So this is the relationship of EPS and DPS in case of stable payout ratio. Stable dividend policy, EPS, whenever there is increase in EPS, you will see there is increase in DPS. And whenever there is increase in decrease in EPS, you will see decrease in DPS. But the payout ratio, this remains constant. 40%, 30%, year after year, you maintain this ratio. 40% of the earning I will distribute. If earning increases, dividend amount increases, but the payout ratio remains constant. This type of policy is known as constant payout ratio policy. Another policy is there. That policy is residual dividend policy. What is residual dividend policy? In case of residual dividend policy, the company follows the following 4 steps. The residual dividend policy support dividend irrelevance theory. There we follow the following steps. First, we determine the optimum capital budget. Then we assess the capital required to finance the budget. Then we use retained earning to the extent possible to finance the project. And the rest, if any profit remains, it will be used for dividend. That means in this case, company first decides its capital expenditure budget. Then what is the amount of capital required for it? Then what is the amount to be used as internal finance? And next, residual profit, if any, that is decided, distributed as dividend. The residual dividend policy can be pure residual dividend policy or smoothened residual dividend policy. What is pure residual dividend policy? We can see it with the help of an example. Let's take an example. There are different time period. Period 1, period 2, period 3, period 4, 5, 6, 7. Earnings are given. Earnings is 150, 190, 140, 220, 280, 250, 290. and capital budget of each year is given 140, 160, 180, 200, 220, 260, 270, and equity investment is given. We know earning is given, capital budget is given, and equity investment is given. And equity investment means internal finance to be used is given. How much internal finance is to be used? Then the dividend amount will be the difference between earning and equity investment. A minus B will be your pure residual dividend. 150 minus 70, that is 80. 190 minus 80, 110. 140 minus 90 will be 50. Next, 220 minus 100, 120. 280 minus 110, 170. 250 minus 130, 120. 290 minus 135, 155. In this way, you design the residual dividend policy. This is known as pure residual dividend policy. Okay. Now please see, if this can be explained with the help of the following diagram. Earning is given and pure residual dividends are given. So this is earning and this is pure residual dividend. Pure residual dividend. Now, you see that in case of pure residual dividend, there is erratic fluctuations in dividend. So in order to avoid the erratic fluctuation, what can I do? I can draw a line, draw a smoothing line which will divide the pure residual dividend into two equal parts. And this particular line, I will pay this amount of dividend every year, which is put on the line. And this is known as smoothed residual dividend. And this line can be drawn with the help of regression analysis, with the help of least square method or freehand drawing method. I can use freehand drawing to fit the line, or I can use least square method to fit the best fit line. I will draw a best fit line which will erase the erratic dividend in the case. In this case, this is known as smoothed dividend policy. So what is smoothed dividend policy? Smoothed dividend policy is more appropriate in case of dividend which show a steady progression. It is a combination of pure residual dividend policy and principle of steady change. So we draw a smoothed line in pure residential dividend policy, and then we smooth the line with the help of least square method or freehand drawing method, and we decide the amount of dividend. So this is the dividend policy. So let me first summarize my class today. What we have discussed in our today's class, we have discussed regarding dividend policy. Dividend policy is all about the policy regarding plowback and payback. Plowback of profit in business and payback the profit to the shareholders. And while deciding this dividend policy, we have to consider several factors. The factors may be external factors or internal factors. So we have discussed different external factors of dividend policy. We have discussed different internal factors of dividend policy. Next, we have discussed what are the determinants of dividend policy. And at last, we have discussed different type of dividend policy, that is stable dividend policy, stable cash dividend policy, stable payout ratio, then other methods of making dividend policy. Next, we have discussed certain keywords in our class. What are the keywords? We have discussed bonus shares, when dividend is paid in form of shares for which shareholder do not have to pay any money, that is known as bonus share. We have discussed stock dividend, that is bonus share. The other name of bonus share is stock dividend. We have discussed stock split, dividing a share into smaller parts, that is small stock split. Reverse split we have discussed. Combining small shares into a big share is known as reverse split. Then we have dividend policy. Then we have a term called EPS. EPS, earning per share, earning available to shareholders divided by number of share. DPS, dividend per share, dividend by number of shares. Then we have discussed payout ratio, that is that percentage of profit which is paid to shareholders as dividend. Then we have discussed retention ratio, that percentage of profit which is retained and reinvest in the business. What are the important questions? Important questions means discuss the factors which are taken into consideration while deciding the dividend policy or dividend decisions. Discuss the internal factors, discuss the external factors, discuss the residual dividend policy, discuss stable dividend policy and its merits, demerits, and sometimes short notes are available on stock dividend, stock split, stock repurchase or buyback of share, tax consideration, recession, and dividend policy like this. And next, these are the certain books you may follow for further readings on this particular topic. Thank you. Thank you for attending the class.